thing you're going to learn in any basic accounting course, right? It's one of the first things you learn. It's also called the balance sheet equation. And if you're taking notes, you might want to jot that down because this will make sense in a few minutes.
Balance sheet equation.
It's also called balance sheet equation because we'll be looking at balance sheets. And the balance sheet is based on this equation right here. So let's go ahead and define some of these terms. Assets is any form of what? Huh? Ownership, or what's that word that begins with a P?
Property.
Property. Same thing. Any form of property that the business owns. We'll talk more about that later. Liabilities, any form of what? The D word. Debt. Yeah. Debt. D-E-B-T. And then owner's equity represents the owner's investment in the company. The best way I can explain this to you is if you look at this equation and you manipulate it and you solve it for owner's equity, you know how to do that using the same things we've been doing all over. How would we solve this equation for owner's equity? We subtract what from both sides? Liabilities. And what are you going to end up with? Assets minus liabilities equals owner's equity. Now think about that. The value of your property minus what you owe to creditors, to the banks, etc., that is what you have left over. And the same thing applies in your life, in your personal life, as you think about it. Because if you buy a house, do you understand how equity works if you own a home? Okay, so you don't totally own that home until you pay it off. You only own a certain percentage of it, and you own more and more of it with each payment, right? A little bit more of it. So it's a similar concept here, okay? Ready for the next one? I just explained this. You don't
Yeah.
need this.
Thank you.
Okay. All right, take a good look. This is an example of what we call a balance sheet. We're going to look at two key financial statements, they're called financial statements, that most businesses, or just about all of them, will maintain. If you're a corporation, you're required by law to maintain them and submit them to the SEC and whoever else, investors,
How often?
bankers.
Quarterly.
Quarterly, probably. But the balance sheet shows three things. And what does it show? Assets, liabilities,
and equity.
and owner's equity. Just like in the equation you just saw. Look at how it's laid out. Okay? Assets are on this side, liabilities here, and owner's equity right below it. Now take a look at the totals before we go any further. What do you notice? These are equal. What did the equation say? Assets, total assets equals liabilities plus owner's equity. Liabilities plus owner's equity. So we had to add total liabilities
Plus the 50%.
and the owner's equity to get this number. Here and here. Now the good news is, the problems you'll be working, well, I better not say anything yet. Let me hold on to that. You won't be doing a whole lot. It's not like you have to build a balance sheet, like you have to build it from scratch, but you'll be using it in the problems, okay? And the income statement also. We've both been sick for a long time. Huh? Yeah? No? Isn't that sickness?
I think it's the wind.
I'm just
Well, I've been
allergic
sick
to
for
math
2
in
months. That's
general.
why I just noticed when people call me. Okay, so I'm not going to go through every single thing here. I'll try to summarize it as best I can because it'll take forever. But you have two categories of assets. You have current assets, current, and you have fixed assets. It doesn't say fixed here, but trust me, it's current and fixed. What is the difference? What are current assets?
What you have now,
Assets are, yeah, I guess current.
what you have.
It seems that way because of the name, but that's not what
Yeah.
it is. Current assets are those that can be converted into cash within 1 year's time. Those assets that can be converted into cash or expected to be converted to cash within 1 year's time. Okay? Cash is already cash. Accounts receivable. What are those? Customers come to your business, they buy merchandise on credit, and you have an accounts receivable account for them. So you keep an accounts receivable ledger, and you have all your customers, they each have their own account, right? And when they come to make a payment, what do? You have to update the account. Now the good thing in here, you don't have to learn the system of debits and credits. I don't know if that sounds familiar, but you don't have to do that in here. So you'll get to avoid that. But let's move along. Inventory you sell to the customers. That is going to be converted into cash, hopefully, within 1 year's time. Whatever inventory you have in month 1, in other words, by month 12 it should be sold. But you keep buying inventory every month, right? Once it depletes, you restock it. Okay, prepaid, any account, these are all accounts. Any account that starts with the word prepaid is an asset. All this means is that we paid our expenses ahead of time. Does that make sense? So we have a claim to those services because we prepaid for them. Just like prepaid rent. Okay? The next category, fixed assets. If you notice it says plant and equipment, these are the things, we call them fixed because we are not going to sell them unless we liquidate or close the business, right? Or sell it to someone else. But we want to keep the building and the land. For the school, if we sold the building and the land, we couldn't have a school, obviously, right? So that's why they're called fixed. And usually the amounts or the balance in the accounts are a lot higher. Land, building, equipment, vehicles, computers, stuff like that. Look at what's going on here. We add all these numbers together, and where do we put the answer? Right here. That's where you got this number. We added all these together. And then we come to the long-term or fixed assets, and we add these two together and put the answer where? Here.
Then you total those
Then
two.
you total these two, and you get this number. Okay? Liabilities, it works in a similar fashion as far as for the calculations. But let's take a look at the categories, current and long-term. Who can tell me what current means? Think about current assets. It's a similar, can be,
Turn in the cash within a
that's
year.
current assets.
It means
Can't be sold?
Not sold. Paid off, thank you.
Oh.
I knew you had the right answer, you're just trying to get the words out, but yeah, paid off. Good.
In a year? Paid off in a year?
Paid off within 1 year's time, yes. Okay? So, look at the account names. If you notice, every account over here ends in what word?
Payable.
Payable. So, if an account ends in the word payable, it is a liability account. It is something we owe. If it ends in receivable, that is the opposite. It is something that we're going to receive. See the difference? Okay? So we add up. Or excuse me, I'm going too fast. Accounts payable. These are people that we owe. Okay, maybe suppliers we have accounts with. And salaries, that's obvious. Those are our employees that we owe. We add these two together. Here's the total. The next category, mortgage note payable. Notice that it's a long-term liability. How come? Because it takes
It takes a long
Long
time.
time.
takes more than a year to pay off a mortgage. Yeah. If you can pay your mortgage off in a year, tell me what your secret is, and I'll quit my job. Okay. So, current liabilities and long-term liabilities, we add these two together, and here's your total. Very simple. So we're done with liabilities. Are you with me so far?
Mm-hmm.
Last one, owner's equity. Now I want to simplify this. This is not an accounting, finance class. It's nothing like that. So I'm not going to go through a whole explanation until a further chapter later on about how stock works. We have a chapter on stock, okay, later on. But this is all I'm going to say. Look at the total stockholders or total owner's equity, this figure, and add it to what?
The
Total
top.
liabilities, and you get total liabilities and owner's equity. Same thing as stakeholder, owner's equity. So you see how we got these two numbers? Any questions? I'm sure you have some you just don't want to ask. That's okay. That is the balance sheet. So we have to do the income statement. That's only one of them. Okay, so let's see. We're going to do a vertical analysis of the balance sheet. Now this is what's really important for you, because this is what your problems look like. What direction is vertical?
Up and down.
Up and down, not this way.
That's horizontal.
And we're going to do horizontal too. Yeah. This is vertical. And there's a reason I'm saying that, because you have to remember how to do these calculations. Pay very close attention. Write this in your notes, because one calculation or one formula will be used all the way down to get all the answers. Now what's going to happen is, okay, the answers are already in here for us. So whenever you get your problems, this will be blank. This column and this column. And that's what you'll have to get. Let me show you how you get it. Okay? You'll take each account, the balance in each account, see? And you will divide it by the base. In this case, the base is always the total at the bottom, total assets. So 22,000 divided by 85,000.
So you divide by the total
Every time.
every time.
I'll keep going on in a minute. But what you'll get here for your answer, if you punch it in, you'll get 0.2588 on the calculator, and then you turn it into a percent, right? So move the decimal 2 places to the right, and you'll get this. Any questions so far?
So basically it'd be 22,000 over 85,000.
Yes.
What are the names of those? Like, if you were to put it out in an equation, like E times T, like, what would the equation be called?
You're totally losing me there.
Like, amount times, or divided by base?
Oh,
Word.
okay. Well, if you watch as I go down, it's the same calculation. Watch the next one. Accounts receivable, 8,000 divided by what? 85.
Right, but that's not what I'm asking.
So the account name divided by the total assets. So the asset account divided by the total assets. That's what I would call the formula. The next one, and that's how you got this answer, 9.41%. The next one, 9,000 divided by 85,000. See how simple that is? And you just go all the way down and you fill in this column.
Assets account divided by what?
Each asset account divided by the total assets.
Mm-hmm.
And that's the base, the total assets. So, notice when you get to the bottom, you should come up with 100%. So if you understood what I just said, that's as hard as it gets here, almost.
Of course, the bottom has to be 100% because you're doing it by itself.
Yes,
And each other.
exactly.
Thank you.
85,000 divided by 85,000 is 1, or 100%. Right. Good observation. So, huh?
I said, your grasp of the obvious is okay.
Well, I don't know if everybody noticed that or
I was
not.
just thinking about it.
But yeah, that's true. 85 divided by 85. And on your problems, you'll probably have to put in that answer. You know, so Keep that in mind, don't let that confuse you. Now over here, the only thing is this is a different year. The calculating all the way down. 18,000 divided by what? 81. See how it goes? All the way down. At the end, 81 divided by 81, 1 or 100. Yeah. Someone's going to miss that, though. They'll be right to me asking, I know I got the right answer, why is it not giving me credit?
You didn't watch my.
Sure. I get nagged every day. Many, many times.
Okay.
Just remember the other thing is rounding.
Yeah, we always have to consider the rounding. It even says it, I even mentioned rounding right here. Yeah.
Yeah, but it's still kind of finicky when you put it in.
Well, if you have a problem, just email me and I'll check.
I don't, it just takes me a couple times to get what they want it to be rounded to.
Well, it's usually the hundredth place, the second place is mine. Usually. Okay, let's see, let's get one more.
Oh.
All right, what's going on here? Oh, okay. All right, this is the rest of the balance sheet. Now, we did the assets. What do we have left? Liabilities and owner's equity. Liabilities, owner's equity. Now, how do you get the answers for this column? Now, be careful. Say again? Same thing as the last one. So here's the formula for this one. The liability account, or the name of the liability account, whatever it is, like accounts payable, and you divide that by what?
44?
Okay, if we divide that by 44,000, are we going to come out with 16.47? I don't think
You have to do it by
so.
the 85.
14,000 divided by 85.
Try to trick us.
It's kind of tricky. So look at what you're
But
doing.
It does kind of make sense.
So that's the liability.
You're dividing each account by the total liabilities and owner's equity, not just total liabilities. So it's a little bit tricky.
Liabilities divided by owner's equity.
By total liabilities and owner's equity added together. So the next one, 18,000 divided by what?
85,000.
85,000. Is that
Because you
coming out
wouldn't get
right?
100% if you divided it by the 44,000.
Okay, yeah. 32,000, they put an extra comma in there for us.
Yeah.
Wow.
Divided by 85,000, 37.65%. Same thing all the way down.
You can make it faster.
Yeah, dropping the zeros can help because these just so happen to all end in zeros. Now in your problems, I don't know if that's always going to be the case. But
It's all 0, 0. What is it? Different.
let's back up just for a second or a couple of minutes, and I want to ask, why do they do this? Consider the last slide we looked at and this one. Why are they doing this analysis?
We're kind of rounding them up.
Well, why are we doing this in the first place?
Well, it's a yearly report, isn't it?
It's kind of like the checkbook in the bank account. You need to balance them out.
It's not so much about balancing it out, it's more about looking at what percent is each account of the total. It's just a managerial accounting decision-making thing. And I don't really stress it in here a whole lot, because here you have to know how to do the math mainly. Okay? But when you track this over time, notice they give us 2 years. There's a reason for that. Because accounts payable, now think about that, that's something we owe, right?
So
It's 16.47% right here. And then in 2010, the previous year, what was it? 9.88%. Now what does that imply?
That means it went up.
Our debt went up. Is that good?
No.
Not usually. But it depends. It really does depend on the situation. Sometimes we have to acquire more debt to be more profitable in the future. It's a necessary evil.
You gotta spit out to get out.
That's exactly right.
Well,
Overhead.
actually, if you look at the retained earnings, In 2010, it was only 16 grand, and then the next year it was 21 grand.
It went up $5,000, which is good. Yeah,
It's a lot better to pay Paul, it works.
exactly.
Yeah,
Do you see what's going on here? That's why they show 2 years, because we're comparing 1 year to the next. And then we'll do 2012 and so on. And we want to look at the trend. What's happening to these numbers? Are they going up or down? Now, whether that's good or bad depends upon the account. Because like he just said, and I'm not going to go into a long spiel on this, but retained earnings is cash that we have in our account. Think about it that way. Cash that we have in reserve on the side. And we want that to go up, don't we? Yes. What about accounts payable? Usually we want it to go down. And what happened? It went up. So I'm just trying to show you, if I give you a little bit of reasoning behind this, it might make it easier when you're sitting down doing these calculations. I don't know. Like, why am I doing this?
Because you said so.
Check. There's some things to figure out.
Oh, it's a lot of fun. Anything more fun?
You could do that with your checkbook, couldn't you? You could, your base pay times whatever you pay out on certain things.
And you can track it over months or years.
It's just like banks with percentages and what they're offering, APR and all that.
You notice the hundreds, right? Again. So 85 divided by 85, 100. 81 divided by 81, 100.
I don't think we do that. If we do, you should really nail us on it.
Good what?
If we do ever do that, you should really nail us on it.
Oh, somebody's gonna get it wrong, trust me. Oh, that sounds negative, but someone's sleeping in here, I don't know who it is.
Yeah.
Even though you're looking this way. He's smart though, he can do that.
You want to put a bet on it, Pat?
Huh?
You want to put a bet on it?
On what?
Someone getting it wrong?
No, I can't gamble in class, they'll fire me for that, so. Let's talk later. All right, so now we're gonna do horizontal. This is this direction. So forget about looking at the numbers like this, like we've been doing vertically. Now we're gonna go like this, okay? And you'll see what I'm going to show you right here. Okay, quit looking this way, start looking this way. One thing to remember, let me just go ahead and give you the formula. Imagine a minus sign right here. 6,000 in 2011, we had 6,000 in cash. And in 2010, the previous year, we had 4,000. We're going to subtract these two amounts and we get what?
2,000.
2,000. And then here's the thing you have to remember. 2,000, always divide by the earliest year. 2,000 divided by 4,000 is 50%. And if you got that, it's like that all the way down.
Okay, say that again.
Okay, again, 6,000
Minus 4,000.
minus 4,000 is 2,000. 2,000 divided by 4,000 is 50%. So what happened here? The cash increased from 2010 to 2011 by $2,000. It increased by 50%, and that's usually a good thing, right? You want more cash, not less, usually. What happens if you see parentheses?
Negative.
It's negative. Okay, take a look. 5,000 minus 6,000. Isn't that a negative? 6,000 is larger than 5. So we have negative 1,000. Now we divide negative 1,000 by positive 6,000. And you know from your knowledge, and yeah, say it again. Well, there's a better way to say it though. In multiplication, division, using negatives and positives, what are the two rules?
Negative and positive?
Yes.
It's always negative. It's always negative. You combine a positive and a negative together, and it's negative.
Correct.
Always.
So if the signs are different, one's positive, one's negative, your answer will always be negative. If the signs are alike, even if they're both negatives, your answer will be positive. You remember that?
Yeah.
Okay, good. That's why we have a negative sign. Okay, let me do one more. 9,000 minus 4,000. Okay, people are trying to listen. You've been doing so good the last 6 weeks since I did meetings, remember? How you doing? Okay, 9,000 minus 4 is 5,000. 5,000 divided by what? 4,000. 125%. So your answer would be 1.25 on the calculator, and you move the decimal two places to the left.
You see those in your head.
125%. So look how much it went up. It went from 4,000 to 9,000. That's more than double, right?
45%.
So 5,000 divided by 4,000?
Mhm. Any questions?
So with the back.
What's that? Where you
That's
at?
where you're getting the negatives and positives, we were talking about dividing.
Yes?
Oh, wait, the 5, are we subtracting the 5,000 from the 6?
Yes.
The 6 from the 5. 5,000 minus 6,000, just as you read it left to right.
It's a negative, it just doesn't have this.
Yeah.
It says 1,000 over there.
Put a minus sign all the way down.
But see, it didn't have the minus 1,000 over there, it has it in parentheses.
Oh, yeah, that means negative. In accounting, if you see it in parentheses, that means negative.
Oh, I didn't know that,
See, at
that's
the
why I was
top it
asking.
says increase, decrease.
Well, I did mention
decrease, and then
I didn't hear you.
Okay. All right, right here. Do you notice why we have all zeros?
Because they're the same.
They're the same. So 12,000 minus 12 is 0. And 0 divided by 12,000, 0 divided by any number
It's zero.
is 0. Very easy. I don't think you're going to get anything like that. So,
Somebody might get that wrong.
huh?
Somebody might get that wrong.
I'll volunteer for that.
Someone's going to get it wrong.
I'll take that one too.
See, I didn't.
always
The
someone.
other thing.
Okay. Thank God you're not have an online class that does all this online.
We'll run a poll in Vegas and see how it
I
goes.
got too many questions.
Now, the total assets, the 25,000 and 21,000, that's that, okay. We don't do that.
You do it all the way down.
So each
Do
number,
it all the way
1,000 is divided by 6,000, 5,000 is divided by
Well, I
4,000.
know, I know that.
You're just doing the same thing all the way. Okay, so
You're not taking the bottom.
no,
No,
we're
the
not
base.
doing vertical anymore. We're just looking this way. Okay, so again, these are called comparative financial statements because they show more than 1 year. Okay, we're comparing the previous year to the current, and we want to see if things have increased or decreased. And then what we do is we make decisions based on those observations. How can we improve the business? You know, how can we get rid of this problem? Question. Ready for the next one?
Now with this one, when it comes to the test, what's gonna be blank on this one?
Both of these.
Both of these.
That's a good question. So when you get to this part, the horizontal, both of these will be blank. And you'll have this.
Oh, you mean for the test?
Yeah, the quiz. Okay, what's next? All this is, I don't think you even have to go over this, because it's just the rest of the balance sheet. It would not fit on one page, obviously. It's the same horizontal analysis. Looking this way, 3,200 minus 1,800 is 1,400. 1,400 divided by 1,800, 77.78%. Any questions on this one? Okay, another one? Okay, something different, income statement. We had an equation for the balance sheet. We also have an equation for the income statement. We have a few of them, actually. I love this. So. Sales revenue is money you get from your customers. They pay for your product or your service. That's revenue. That's what it means. And your operating expenses are things like salaries, advertising, what else?
Insurance,
Insurances,
Security.
rent, huh?
security if you need it.
Security, possibly. What?
Consumables?
What do you mean by that?
Like if it's
Inventory?
sorta, it's like at a shop. If you're using all the grinding discs, grinding mills, and something that goes out on the floor to
Mhm.
be used to produce a product, isn't that considered operating costs, under operating costs? We call them
Yes.
consumables,
Yes.
because we
Yeah.
consume them up, but they're used for that job.
Right, it should be. But it's a manufacturing
Yeah,
environment you're talking about. And here we stick to mainly service and retail. Service and retail. A service business would be like a school, a doctor, an auto mechanic. You don't buy a physical product, you buy a
so it would
service.
be automatic, because there's consumables there too.
Okay, I'm not even gonna go there. Just trying to get through this. Life is
I know,
hard.
I'm just trying to.
This is a very simple business, it's,
Yes, it's
yeah,
just,
very simple.
we're keeping things simple. So, but the total expenses, you subtract that from the money you bring in, and you're left with profit. We also call it net income. Now, what if your expenses are higher than your revenue?
Yeah.
So it's revenues minus operating expenses.
What's the answer? What is it called? Well, if your expenses are higher than your revenue, you don't have a net income, you have a net loss. And you might get that on some of your problems. Okay, now retail business. This is much more complicated because you're dealing with inventory, and that's the only reason. So in the next slide, you're going to see, or it's coming up, you have a few formulas that you have to learn. You're probably not going to like this. We have to do it anyway. So this is the money we bring in from customers or from selling our inventory. It's called the same thing over here. Now, cost of goods sold or cost of merchandise sold, wait till I get the whole statement up here and I will cover it because I don't want to do it once and then go back and do the same thing again. It's wasting both of our times, right? So just hold that thought. But when you subtract cost of the inventory sold, only the inventory that you sold, not what's still in the warehouse, then you get what's called gross profit. You subtract from your gross profit your total expenses, just like we did over here, and you're left with net income, just like here. Okay? So the only thing different here is the inventory. But it makes the income statement a lot longer. I mean, you have a whole section that's just for cost of goods sold. Okay? You'll see in a minute.
Mm-hmm.
Always so, because I'm kind of like breaking things
Well, right now, we're going to look at it again,
differently.
where it shows numbers, and it'll make
Like
more
ours,
sense.
when we get the I over
I?
the. Our other formula, I'm trying to write a formula, and that one just didn't have.
Oh, okay.
Like I got
Oh, the
there,
interest
R
one.
minus OE equals net income. Now over here it has minus equals minus.
Oh, I see. Well, there it is.
Well, not, well,
Revenue minus cost of goods sold equals gross profit minus operating expenses equals net income.
so you minus off the gross profit, the operating expenses.
Yeah, you
and then
subtract,
do
and
another-
I'm getting ready to show this in a whole income statement.
Okay,
And that way you'll see the numbers. There you go. Now, let's start at the top. Gross sales. Why do we call it gross?
total.
Because that's before we subtract.
Before taxes.
Before we subtract taxes or any expenses or the cost of goods sold. So in other words, this is like our raw sales before we subtract anything. We don't get to keep this amount, do we? What do we get to keep in the end? That. So,
That's like, you get your check, that's your gross, but then taxes come
Exactly.
out and this is
Yes.
what you get.
Oh,
Minus your
and
medical
in a socialistic country, they can take out 75% taxes, so we're not too bad here, actually. Okay, so
Then you get free medical there and all that other stuff.
what was the quality of the service, you know?
I think that's in Switzerland, they do that.
Yeah, they
got
do.
high.
And, okay, follow me. Now, the slide coming up after this will show the formulas that I'm getting ready to talk about, okay? I'm going to tell you them as we're going down all the way down to the end, but there's a slide that comes right after, believe.
So is this vertical?
That shows you all four of them, okay?
Right.
So just keep that in mind. This is not nothing.
So is
Wait,
this vertical?
that's not correct.
Is this vertical?
We're not even there yet. We're getting there. You're way ahead of me.
Sit back in your seat, play your little Game Boy, like over there.
No, we're gonna get there. We're gonna do vertical and horizontal analysis. But right now, I'm just explaining how it's built. Okay? Because you will have some problems where you have to figure out cost of goods sold. I'm telling you ahead of time. That's why I'm going through this. You have to use those four formulas that are on the next slide. Okay? Let's make sense of this. Here's our gross sales. Now here's a formula that you have to know. You might as well write it down. I'm not sure if it's on the next slide. It might not be.
Depends on which one it is.
Gross sales minus sales returns, also minus sales discounts. So we're going to subtract these two amounts from gross sales.
And that makes the net sales?
And that gives us net sales. That formula is on that
It's the
slide.
very first one.
It's on there.
It's on the very first. I've
Good.
got 2 slides on one
Equals
sheet.
net sales.
Let's say that again. Net sales equals
where?
gross sales minus sales returns and sales discounts. Notice how we add them together. Do you see that? We add them. That's how we got this number. And then we do what? Subtract that from gross sales. Again, let me repeat it. Gross sales minus sales returns and sales discounts equals net sales.
And where's net sales? Okay, I see it down there.
Here's your net sales. It's kind of off. Do you see how it's a little bit off there? They don't have it exactly even.
See, I don't want this. Why do they have to do different configurations? Why can't they
'Cause
just do it
they
in one
did it.
set? One set way of doing it. It's crazy trying to figure out what's what. It reminds me of Excel. I hate
I love
Excel.
Excel. Okay.
Like
Net sales. This is our net sales. Okay, the conversations, people are trying to concentrate. Okay, net sales. So that's one formula you have to know. The next one is cost of goods sold. That should be on the next slide also. Cost of goods sold. Now this can be tricky. This is the toughest one. So watch closely. On the first day of the month, we go in the warehouse on December 1st, and we do a count to see what the valuation or the dollar value of the inventory is on the first day of the month. And that dollar value is $1,248. Well, we're low on inventory. We're low. We have to buy some more. So what do?
Purchase.
We purchase more inventory. We purchased $10,512 worth. Follow me so far? So merchandise inventory, beginning inventory,
So
BI, plus purchases, that's where we're at right now. Beginning inventory plus purchases of more inventory. But we have to subtract something. First, take a look.
Discount.
Purchase returns and purchase discounts. Now think about what that means. If you own a business and you get something that's defective from your supplier, what do you do with it?
Send it back.
Return it. So they're going to give you a credit for it. They're going to give you a credit for it. Don't let that confuse you, please. It's a credit, but we're going to subtract it here, okay? Purchase discounts. If you buy in bulk, if you buy a lot, don't you get a discount? If you go to Sam's or something, you get the candies that have like 20 in a pack as opposed to 1, you're going to pay a lower unit cost, right? So that's purchase discounts. Now we add these two together, you get $540. And we're almost to the end here.
Still gotta subtract.
Right, we take 10,512. Okay, we subtract what from it?
540.
540.
And you get 9,000.
Actually, hold on. Give me one
wait,
second.
I'm confused.
Don't worry, we'll fix it. Beginning inventory plus purchases minus purchase returns and purchase discounts, which is 540 altogether. Then you get this number.
Plus purchases.
Did you follow me there?
Yeah, I follow. Why do they have to flip flop it all over the doggone place?
Cause,
Okay, beginning inventory plus purchases, what?
To me, it makes it harder to read.
let me say it again.
Simpler.
Beginning inventory plus purchases minus both of these together, you have to add them together, purchase returns and purchase discounts equals this number, the cost of net purchases. We're not done yet. We have one more step. Now right here, how do we get this number, 11,220?
Yeah, added 1248.
Yes, 1248 plus 9972. Now we're getting closer to the end. We have the cost of merchandise, or excuse me, goods available for sale, right here. This is a very confusing concept for a lot of people. When I took accounting,
Yeah,
it took me a while too, okay?
that's what I'm trying to figure.
But as long as you can do the formula on the problem, you'll be okay.
Okay.
So right now, there's one more step we have to do.
Ah.
Look at this. Less merchandise inventory. This is the last day of the month. So we go in the warehouse on December 31st, and now we're going to count up and see how much is the inventory worth on the last day of the month. Remember we did it on the first day in the beginning? Well, now we have to go on the last day to do it.
Ending inventory, minus.
And now
ending.
we're going to subtract that from the 11,220. And we finally come to cost of goods sold, which is what you're trying to get. Does that all make sense? Now, who can tell me, why do we subtract this?
Well, it's,
Because it's probably merchandise
You know-
that's not the place, so it's still-
You haven't sold it.
we're spending it.
No, you haven't sold it. It's still in the warehouse.
So I mean, you paid for it.
You paid for it, but you haven't sold it. So we can't include it in the cost of goods sold. Does that make sense?
Yeah, because it's still in
Cost of
inventory.
goods sold. It's still in the inventory. Good. So that's why we subtract it out.
This reminds me of, this is a word
So-
problem.
If I,
It
And you're
is.
Explain
finding
this.
where the numbers are and pulling them out.
A lot of
and putting them in
numbers. Trust me, the most difficult thing in this whole chapter is cost of goods sold.
so
So-
is what I have is beginning inventory plus purchases minus purchase returns plus purchased accounts minus ending inventory equals cost of goods
Yes.
sold.
Right.
Got it. Okay.
As I said, language.
On the next slide, they show the formula. Question.
Never mind, you're about ready to answer it, they showed the formula.
And I'm going to break it down a little bit further because they give it to you, but I don't think they give it, they don't give you all of it, okay? You'll see.
We might need a little more time.
That's okay. We'll take whatever time we need.
Okay.
Okay, so where are we? We're done with the hard part. I think we're done. Okay, so this is cost of goods sold. Now, cost of goods sold is right here. This next number, how do we get this number? And this is called what? Gross profit from sales.
Subtract it from the 20.
And this is your third formula on that next slide. You take what? The 20,566, which is your net sales. So net sales minus cost of goods sold is what?
Gross profit.
Gross profit. Net sales minus cost of goods sold equals gross profit.
I swear it sounds like you're saying cost of goods sold.
Yeah. Of what?
It
Goods
sounds like you're
sold.
saying cost of goods sold
What was it,
each
net
time you
sales?
say it.
What's the last word?
Sold.
Sold, like your
Sold,
soul.
like your
it's nice
soul.
then.
Yeah, I guess I'm like.
You know it's sold though.
Yeah, I
Sold
think
up.
I was just saying, but it is just what it
Sold.
sounds like.
Yes, ma'am.
Well, when you're in business, you sold your soul anyway. So.
Yeah, that's true.
Good
And
point.
then your children too. That's down
You have
payment.
Okay, we're almost done. One more formula for the income statement.
Oh my goodness.
At least with
One more?
just this part. So, I don't think anybody's too bored right now, right?
Would add on
Never.
that.
Okay. All right, here are all the operating expenses. Salaries, insurance, utilities, etc. We list them and then we do what? Add them together.
And
And then simply subtract total expenses from gross profit and you get net income. Gross profit minus total expenses equals net income.
So we took the 10,927.
There's your four.
Gross profit.
Subtract 4,000 and we get the 6.
Yes.
Okay.
So the income statement of retail business is built on those four formulas. Who's majoring in accounting again?
Oh, I'm business.
I know you are. So you know all this. Anybody else? No?
Operating expenses.
You want me to say it again?
Yes.
Gross
Equals
profit
income.
minus total expenses equals net income. Okay, here it is. This is what you have to know. Now on this, I might have to give you a little bit more information if it's not all in here. Let's go ahead and start off with net sales. This is the first one we did, right?
Yeah.
They go in order, just like we did them. So the first one, gross sales, which is the first figure on the income statement at the top, right? Now sales returns and sales discounts, I didn't define that. What is that? When a customer buys from you and then their product is defective, like when you bring it back to Walmart, which has the awesome return policy usually, and they give you a credit or they give you money back, so they have to give you that back, give it to you, so they're losing that. Does that make sense? They're giving it up, okay? So sales discounts, very simple. Sometimes when you buy more as a customer, you get a lower per unit price. You might get a discount for many reasons, but that's all it is, a discount. Okay, next formula, number 2, cost of goods sold, our favorite. Beginning inventory, remember, as of 12/1 on our example. Beginning inventory plus, they call it net purchases. Now, take a look, they've combined some of this stuff. Net purchases is a separate formula within itself.
Oh, God.
It is a separate formula within itself, but it's easy. Here it is. It's purchases, they missed the S here. Purchases minus returns and discounts.
Okay.
So you might want to add that in the notes. Net purchases equals
Man, it went all the way around.
Equals.
purchases minus purchase returns and discounts. Net purchases.
So you got beginning, which is, you add that, oh, you gotta do that for the parentheses first. Then you
Yes.
add, then you.
This is an embedded formula. Think about it that way. It's a formula within a formula. So the last thing we have to do, we're almost done, is subtract out the amount of ending inventory. And that was as of 12/31 in our example, remember? And you get to cost of goods sold. Now, if you think about these words, think about each word. Cost, what we paid as the business, what we paid for that merchandise, but just what we sold, not what's still left on the shelves or in the warehouse. That makes sense? So we're only recognizing the cost of what we sold, not what we still have. Okay, ready for the next one? It's easy now. So the third one, gross profit. We just call it gross profit. That's good. So net sales, and notice something. You had to get net sales up here. So you can't do this formula until you do the first one. Net sales minus what? You notice that's the second formula? So this is just the first formula minus the second one. Easy. Gross profit. And then the final one, net income. It's also called the bottom line. If you've heard that before, the bottom line. It's at the bottom. Gross profit. Where do we get that from? We did it in step 3. Gross profit minus total expenses. Total expenses. Any questions? We're not done with the income statement yet. We still have to do the analysis.
Oh.
This is just how it's built.
Like 4 more slides.
I don't like this chapter.
I like it because I get tired of boring stuff.
Yeah.
Or stuff that's-
Once I get into it, probably.
Okay,
I did this.
all right, here's the vertical analysis.
That's the way to learn.
So, you're gonna notice something different here. It's very similar to the vertical analysis we did in the balance sheet, but there's one big difference. Your base figure is this number. Do you remember on the balance sheet, it was total assets down at the bottom? Well, now it's net sales. Do you see to the right of net sales? You recognize something?
Mhm.
100. So how do we get that answer? 45,000 divided by 45,000. So how do you do the next one? 19,000 divided by 45,000. Get this number. Next one, 26,000 divided by 45,000. So on.
Now, the other one was based on what again? What was
The balance sheet, it's the base figure is down here.
Yeah,
well, but it's based
On
on your
the
net
income.
income and not the net sales.
No, it's
Net-
based on net sales here.
No, I'm saying the other one was based on net income.
Total assets, or where are you going? You're going in two different directions
You
here.
said this one was different from the others, it only.
From the balance sheet.
From the balance.
Because
There's
the
no net
balance-
income on the balance sheet.
the balance sheet, the total's at the bottom, on the income sheet, the
Correct.
total's at the top.
On the balance sheet, the total's at the bottom, the base figure, and on here it's
This
the
one's based
top.
on assets, that one's based on net sales.
Yes, correct. Okay, this is for 2011. You do this all the way down. The last one, 5,900 divided by what? 45,000. 13.11%.
So you just flip it, it's the opposite. I mean,
Yes, the
You
base
just-
figure is the top now.
You do them the same thing on the other side.
Same thing here. This is just 2010. 29,000 divided by 29,000. 12,000 divided by 29,000.
See the way you looked at me.
41.38%. Okay? Any questions so far? Don't get the two statements confused, the methods, because if you get them backwards,
You're gonna be
you're going
in
to get
trouble.
everything wrong. You have a big headache.
And then you'll be that person who misses 100%.
Yeah. Someone's going to miss it. Okay.
Don't be that guy.
Okay.
All right. I have to point out an error in the PowerPoint here. I think so. Hold on a second. It might be the next one. I think, no, might be the next one. Let me make sure. Yeah, it's the next one. Okay. Let's make sure before I go. Okay. Here's 2010, here's 2011. Imagine what right here,
Minus 9.
okay? Horizontal analysis, horizontal, but it's the income statement. So we did horizontal analysis on the balance sheet, now we're doing it on the income statement, okay? So, horizontal,
So is there any difference in this one?
there's always some difference. It's basically the same. I think it might be the same exact way, actually.
90,000 solid.
90,000 minus 80 is 10. Okay? Why they didn't give us an answer here, I'm not sure. I wouldn't worry about it. But look at the next one. 2,000 minus 2,000? 0. Your answer is going to be 0 right here. Look at the third one. 88 minus 78?
10,000.
10,000. Now, hold on a second. Somebody punch this in for me. Anybody? Divide 10,000 by 78,000. It is? Okay. Just making sure.
So you,
What did you get? 68?
10,000 divided by 78,000.
Yes.
12.82.
Okay.
Yeah, it's good.
All right, it's good. Just making sure. All right. So you see how we get this? 45 minus 40 is 5,000. 5,000 divided by
40.
40,000. So is it the same thing as the balance sheet?
Yeah.
Isn't it?
Mm-hmm.
Isn't it exactly the same? Okay. So that helps you out a little bit.
So you always divide it by the
Then-
least year.
Yeah, the least year.
Yes.
Okay,
That is your
that's-
base year.
that's what I'm-
Yeah, they're written down.
Thank you.
No, income
Okay. If you see anything in parentheses, what does that mean? Negative. There's a lot of chatter in here. 600 minus 1,000.
That's
It's a negative 4,000.
Minus 400. Negative 400. Any questions on this one? We're just about done. Good. Okay, one more type of problem. You will see a couple of these, okay? And it's called a trend analysis. Let me go to the next slide. This is the last slide, and I'll show you how to do it. You will be given all of these numbers on your problem, and then you'll have to fill in something like this, the whole thing. But it's one formula used over and over again. And they show you right here, they give you a hint. Let's take a look. Your base year in this problem is always going to be the earliest year, as usual. So 2009. What do you notice down here in the answers?
They're all 100%.
You should have 100%. Because 420 divided by 420 is 100%. Now, what three things are we looking at? Sales, gross profit, and net income. We're comparing them from 2012 to 2010 or 2009. That's basically what we're doing. So let's look at a few more. This one here. How do we get this 81? They show you right here. 340 divided by 420. What about the next one? 460 divided by 420. 621 divided by 420. So how would you do the next row?
Same.
112 divided by 124.
So, but then you plug it in.
Down at the bottom when you
Yes,
get your
this
answer,
is where you put the
plug it in?
answers. This is where you put the
So where,
answers.
that's where, that part right there is gonna be blank
Yes.
on the test?
Yep.
So, we're just dividing one, you said that we're dividing one.
So for 2010, in the sales row, you do 340 divided by 420. And then in this, for the bottom in the second row, you do 112 divided by 124 to get the next number.
And then this one, 22 divided by 38.
38 to get 81, 90, and 58.
So in other words, whenever you're looking at this one, you're going to plug your answer in the same place at the bottom, right here. Do you see 2010? 2010? And it's the third one. I mean, it's in the exact same place, just at the bottom. Just plugging it in.
Okay, that's that one. So the next one over there,
I see how it goes.
Which
I
one?
do too.
It goes boom, boom, boom.
Mhm.
Yeah, it goes these two and then these two. Yeah.
Same thing over and over.
so the second one would be 621 divided by 460 to get the 110.
621 divided by 420.
420.
148%. You always divide by this number.
And then you do
By
the
2009.
182 divided by 124 for the second
182
number.
divided by 124,
Gives you that.
147.
Mhm.
It shouldn't be too bad. Okay, I have a headache. I'm sure you do too. I'm serious.
Let's do fun.
Fun.
I'm ready for a beer.
Okay. When we come back on Monday, we go over the quiz review as usual, right? And then we move right along, do the same thing, another chapter. Spring break is coming up.
The
When?
last week of March.
The last week of March?